Well, hello and welcome everyone to your FOMC Meetings live trading event. It is exciting to be here as always. Corey here with you, and we're going to go into and look at what the Fed is looking at.
Disclaimer. This video was created for professional Forex and crypto traders. Maverick Currencies is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional Forex and currency trader for Maverick, click the apply button in the video description. Let's break down what happened today.
Why or why not they may raise interest rates, cut interest rates, what they're going to do, and let me just take a little bit of the guesswork out of it. They're not going to do anything. These rates are staying the same at 5.5%, and they're going to stay the same for longer than what the markets had anticipated. So we came into this year with this expectation. I couldn't understand it, but Wall Street had this expectation that the Fed was going to be in a big interest rate cutting cycle. Goldman Sachs had them for like 6 interest rate cuts or something along those lines. And I just didn't see it. And we're already past where they thought that the Fed would start cutting rates right here, right now. There's a very good chance that they're not going to cut at the next meeting and so forth. And so the messaging around this is one where they're going to have to continue to tout that, hey, things are working, inflation is okay, it's not great, it's 3%, they wanted it 2%, but these interest rate hikes have worked to pull inflation back. Now, inflation's a tricky thing because prices have already inflated up, right? They're not climbing by 8% every single year, but they've already climbed dramatically. And so we're not deflating, prices are not going back down. It's simply that they're getting it back to a more manageable number so that prices are going to increase another 3% this year and then another 3% the next year. So the genie never goes quite back in the bottle, right? Prices tend to rise. And why would the Fed start cutting rates? Why would they risk that inflation would get terribly out of hand? You have to think of it from the Fed's perspective. They're looking at it and the economy's chugging along. The financial markets are behaving well. Stocks are at new all-time highs. All these things are looking pretty good. So why on earth would they come in and start aggressively cutting rates or even gradually cutting rates? There's no driver right now for them to act. Now, when they do start cutting rates, history says that if they do it in a gradual fashion, let's look at the chart here. If you imagine that they cut rates a little and then it kind of flattens out and then a little bit more and it flattens out and a little bit more, and it was very gradual over time, that's usually a good thing because they're just sort of adjusting, nudging, and so on. If they were to come in and aggressively cut for multiple periods of time in a row, that means they're reacting to something more severe. And generally speaking, you think, well, rate cuts, that should be a good time to be bullish and risk on and so on. That's not really the case. Generally speaking, if they're aggressively cutting, then something has gone wrong that they're reacting to. So even the manner in which rate cuts happen in the future is going to be interesting to see and really tell us a lot about whether or not they're reacting to some sort of crisis or whether it's just that gradual adjustment. Now, we know, and everybody knows, that the Fed is not doing anything with rates this period of time. But the statement and even the press conference after, these become the bigger moves because it's no surprise to anyone that rates are going to stay at 5.5%. I mean, that's a 99 point whatever percent probability. They're just not changing rates at this meeting. But in the statement, they're going to give some guidance as to, well, what are they seeing? What are they expecting for the future? What are some word changes that they're making? is this going to be a process where they're going to start to cut rates and they foresee that they're going to in the summer months or what have you? Any guidance that way. And I suspect that their guidance will continue to be that they're data dependent and so on, but it should be a little bit more hawkish just from the standpoint of, again, what's the driving reason for them to start cutting rates? There just isn't one right now. If we look at their press conference, sometimes what can happen is the US dollar makes one move for the first 30 minutes and then on the press conference actually makes the opposite move. So it's not uncommon for the dollar to kind of burst up or something and then the Fed says something and it gives that back quickly, or vice versa. It falls on the initial and then it rebounds on the press conference. So no guarantees that that happens, but there's kind of two events. You have to trade the FOMC statement and the announcement and so on. And then about 30 minutes later, the press conference comes out and just one comment, just one thing from Fed Chair Powell can get markets moving, where the markets say, oh, this was much more of, bullish or bearish or hawkish or dovish or whatever. And this is just on a daily time frame, mind you. Japanese yen is interesting. It started to sell off aggressively, where if you look at the calendar for this week, we're stacked with items. We had the Bank of Japan and their policy statement, and they're moving away from, you can see, the interest rate hike. They have now finally, they're the last central bank to do it, they've moved out of a negative interest rate policy. Now that seems kind of hawkish, right? They're raising rates, yet the Japanese yen is selling off, even on that news. I mean, it's just one of those things where the Japanese yen historically has had a tendency to go down over time. We've got the Fed meeting, then we've also got the Swiss National Bank, we've got the Bank of England. I mean, we've got a lot of stuff going on this particular week, but that's the Japanese yen selling off aggressively following their statement. The US dollar has bounced back, and as we look at this level, um, if you really go back quite a ways, I mean, we can look at some key levels and whatnot, but you basically are back to an area of, this was a breakdown zone, and then we recovered back up, and now we're kind of back into this zone where these highs and this prior breakdown occurred. So the ideal setup, even if you wanted to buy the US dollar, would be a sort of give back, some sort of cup and handle, little corrective phase here before the next advance, and you'd be trying to buy on this dip. I don't know that today's going to bring that necessarily, but that would be the ideal bullish setup, would be following a couple of day decline and give you a nice bull pullback setup right in here. It would fit across multiple different concepts of, you're buying the dip as these moving averages are coming up underneath to provide some support, that type of thing. It could be like we said, kind of a cup and handle type of pattern. You could call it an ascending triangular type of pattern, what have you. But from a technical standpoint, it's hard for me to buy the US dollar other than just for a very, very short term trade. I mean, we may buy the dollar today on the Fed meeting and be in and out rather quickly, but we're coming into resistance and we've just expended a lot of energy. I mean, this is a multi-day rally back up to resistance. So can it have a little more to go? A day or so? Sure. I just think a pullback is ideal and imminent within the next few days. I don't know that it's imminent's probably not the right word, but within the next few days, I would expect some sort of pullback correction to start to occur. Swiss franc, I've talked about in the daily recaps. This is just a currency that has continued to trade poorly. Euro has been a personal favorite, and it has done nothing to disappoint. So if you're remaining long Euro pairs, you're very, very happy with that result. British pound another. I've named them my two favorites for the past few weeks. And again, they've just done nothing to disappoint. So if you've been on that euro and British pound upside trade, that's pretty good. CAD has reemerged as an interesting one. And even before this break higher, I talked about it on Monday in the recap 2 days ago, where CAD is reemerging and oil prices have really started to recover and such. So if you wanted to buy out of the risk on commodity currencies, I much prefer CAD over, certainly over New Zealand dollar, and probably even over Aussie, although Aussie looks pretty good here for a potential upside break. Look at that nice high base and could break to the upside there in Aussie. Kiwi, still don't like it. We've talked about it. It's one of the best bearish candidates. I mean, the obvious choices are Swiss franc and New Zealand dollar on the downside, and it's been euro and British pound on the upside. That's your bull and bear list, and it just continues to play out. Now, obviously, trends and momentum and things are meant to be changed, but that's the way I look at these charts, these technicals. Now, of course, our special focus today is on the US dollar. So let's come into the US dollar chart and compare it to a few different time periods. Well, on the 12-hour, you can see how we're up into that resistance. On the 4-hour time frame, you might start to see it if you kind of scroll back a ways. But essentially, you can see that kind of bearish to bullish reversal where we've come back up to that resistance zone. On the 1-hour chart, again, you can see, I mean, all of these time frames are still bullish, right? We are encountering resistance, but notice on the daily, the 12-hour, the 4-hour, we're in uptrends across all of those time periods. So for me, I mean, I would still focus on this more on the long side, certainly than on the short side as a US dollar pair. In the very, very short term, this is a 30-minute chart, we've pulled back towards that 50 period moving average. Now, let's go look at some possible trades. Sticking with what has been working, and then maybe even thinking outside the box a little bit, which I like to do from time to time, especially on these events, and say, okay, we know where the puck has gone, but as the great one, Wayne Gretzky, would say, I want to skate not to where the puck is, but where it's going. So let's think about the US dollar from that standpoint. If we were looking at this, against the Swiss franc, well, it's bullish. Against New Zealand dollar, it's going to be bullish, right? Pair against, oh, there it is. New Zealand dollar against US. Well, you can see that New Zealand dollar is in a bearish setup. So maybe that's just the obvious trade. It's the right trade. Perhaps we stick with that. Now, let me say that from an equities perspective, if you're taking your cues from stocks, I don't love the setup long term for the S&P, but there's something that happens, and this is true in all markets. When something has been on a run, you have to think about who's in pain. The pain trade and recognizing the pain trade is vitally important to your success as a technical trader, because where the pain is, that's where the momentum is. Where the pain is where oftentimes this will be inflicted to a point where you can almost hear it when someone's in pain, right? And you'll see it in the chart. It's almost like it's making a noise, because as the S&P runs higher, and we've recently consolidated, we know that the buyers, the bulls, are not in pain, not at all. But anyone short this equity market is in pain. And so the question is, how much pain is going to be inflicted before this thing finally reverses? And the stronger the upside, the bigger the pain, and people just don't have the pain tolerance to withstand this, because as the old saying goes, the market can stay wrong longer than you can stay solvent. So the point is that people will be carried out of their trade via margin liquidations from brokers and forced liquidations. That way they'll hit stop losses, they'll give up and throw in the towel. There's just a pain factor that's in place, and the S&P has that dynamic in play where it could still go higher in the short term, and it may do that just to simply inflict pain on the short sellers before this thing's finally done. It's sort of like emptying out. You have this battle between buyers and sellers. And so these are the people that are short and these are the people that are long. Well, if you go high enough, you'll run out of people willing to buy, and the short sellers will probably be the final buyers, right? The people that are willing to buy, unless this goes viral and people just lose their minds, at a certain point, people will just say, well, I can't buy any more up here, right? The final buyers will be the shorts that have to cover and buy back their shorts. And that's like you've run out of buyers. These people have been liquidated. These people no longer will buy, and there's only one direction you can go, and that's back down. And have the short sellers gone through enough pain, been inflicted in that way to create the market top? Perhaps not. So what I'm arguing is more of kind of that, equities and currencies and so on may experience, I think Bitcoin, by the way, I mean, if you want to talk about where you empty out the buyers and the shorts scream out in pain, Bitcoin has already reversed. Crypto has already seen some of what I'm detailing there, where I think there was mass amounts of pain and kind of euphoria and so on. So if you look at crypto on a daily chart, let me come in here. Well, let's just pull up, I don't know, Litecoin or whatever, something that has a whole lot of momentum or what have you. But if you look at this, and if you go back further, I mean, this is something that had been going up and going up for some time, right? So it had gone up back here and then it dipped and it had gone up. But look at how big the reaction is. And at the tipping point, you see how the biggest candle you can see was actually the tippy top. And that's what I mean by just infliction of pain to those that are on the wrong side of the trade. And will the S&P have this big of a percentage move and this big of a candle? No, of course not. The S&P moves a lot less volatilely, but it'll have a rhythm to that, right? It'll rhyme with that. Meaning, if you look at the S&P chart, the question is what will be the final punctuation? Well, it might be somewhat similar in that we may advance and then there may be a really big size candle. It won't be a Litecoin type of candle, but as big a candle as you can almost see on the chart that really tells you, okay, this is the exclamation point. This is the end of that run. This is where the final buyers, the shorts covering, so on, it's reached its peak. And, that's what I would be anticipating and looking for. So if we wanted to play US dollar from a risk on perspective, and thinking that there could be this final push and this final run, it would make sense that the currency pair that makes better sense would be dollar versus Swiss franc from that standpoint. Because dollar versus Swiss franc, you're basically trading historically speaking, two risk off currencies, two defensive currencies. And in this case, I mean, I think dollar could go up versus Swiss franc, would be more likely than if you got a carried away move. You might worry that the New Zealand dollar might bounce, if risk taking started to take hold and it were to filter from equities into currencies and so forth. So that could be a little bit of a concern. We might look at this and maybe I'm going to pull up, I've got some Bollinger Band charts here. And I'm going to pull this up and look at this on some of my dollar pairs, because sometimes I just don't have a strong opinion as to which way the dollar is going to go. So I'm going to flip through a few of these dollar charts and just show you where we hit something that stands out as like a Bollinger Band type of dynamic, because the dollar's been in a little bit of a correction. See that? That's dollar Swiss franc pair, and that's a perfect Bollinger Band setup. You hit the lower band, you're still above the 50 period moving average. About 8 days ago or whatever it was, you could have bought there. Well, now let's go into maybe a 1 hour chart and see if anything sets up and anything has more of a Bollinger Band system. Not seeing anything quite yet that meets our criteria, so I'm just glancing through them. And we've got nothing there. Let's go into a 30-minute. Okay, dollar against the yen is actually very close. See how it's above the 50, didn't quite touch the band, but that would be the essence of the trade. That one's above the 50, so doesn't fit. Same thing with pound. Euro and pound, really don't probably want to short them anyway because they're stronger currencies. Okay, here's Kiwi versus US dollar. It's meeting the bearish Bollinger Band criteria. Dollar Swiss franc is not. So I guess it goes a little bit against what I was talking about in terms of that risk on approach. But frankly, my favorite setup on a technical basis. So I think we were debating between whether we get short the Swiss franc or the Kiwi. I think I'm going to lean the Kiwi on this one. So here it is at 60.41. It'd be aggressive to short right here, right now, because we're going into the Fed meeting. But I'd be ready to short immediately. So have a sell short ready. Put your quantity in there. I've got another screen up, so I'm going to operate on another screen. Put it in. Okay, so it immediately shot up. That's US dollar weakening. So I'm not going to trigger any short, but I'm going to have an order ready. Let's see if this thing fades. Oh, you know what? This is the damnable misery of the Kiwi. I forgot. It goes silent every day at 2 p.m. for its 15-minute window. So that always catches us on the Fed meetings. I spaced it on that one. But the Kiwi, we're not even going to be able to place a trade for 15 minutes because this is the time period where it goes dormant. The others go dormant for 15 minutes later today, but Kiwi does that at this period of time. So at 2 p.m. Eastern time every day, Kiwi has that 15-minute window of daily break. But let's look at what the dollar is doing. So you can see euro spiking against the US dollar, aka the US dollar is selling off, right? So we know the dollar is getting weaker. We were looking at it a little bit more on the long side. If we were going to short US dollar, we talked about euro and pound would be the candidates. That wasn't the current momentum, but it is the reaction. So that puts us in a little bit trickier spot here in terms of possible trades. Both of these, euro and pound, have little breakouts occurring. See the downtrend line? You can snap a trend line. Look what I drew it, but look at this trend line. If I drag it, and then I'll make it even a little thicker. I didn't draw it perfectly where I want it. I'll reconfigure it just a touch. But you can see this trend line here, and I'll erase my drawing because this will be a lot cleaner technically. But if you look at that trend line, see the trend line here that's been in effect. Okay, it hit that high, it hit that high, it hit that high, it hit that high, and now we're breaking out above that high. So the idea here is basically a bearish to bullish reversal on a breakout. You can chase the momentum. That might be the right trade. I'd be inclined to pick it up closer to the retest. Maybe if we hold this breakout and then get a little pullback to the trend line, that would be more enticing to me for a long pound USD trade. But the dollar we were gearing up to continue to play its upside momentum. That's not happening to this point. I should mention also the S&P is not moving a whole lot. There's not a ton of energy in this, a little bit more in currencies than in equities. This is the 30-minute chart, but if you look at the daily chart, we're up all of, quarter of a percent. So not much. I mean, looks okay. We're certainly breaking higher. It speaks to what we talked about, which is there may be an infliction of pain on the upside towards the short sellers and such, but right now there's not a lot of, there's not a ton of momentum in equities. Again, US dollar, the knee-jerk reaction was selling pressure. Whoops, was some selling pressure here where it's falling off of the highs against that resistance. The next best trade, in my opinion, again, we're back to the daily chart, but if this could pull back for the next day or two, it might, be the ideal setup is to be a buyer of the US dollar here a couple of days from now on that pullback. That was where we started. That would be the ideal outcome, but kind of difficult spot here to trade it. I was more inclined to chase, to just kind of play its upward momentum if that was a setup, and it didn't give us that today. So I think we have to wait and be patient for the right pitch to swing at. Yeah, the chart that I saw that looked best from a trading standpoint was Kiwi US dollar on the short side on the 30-minute time frame. So the idea would have been if you reversed here, imagine it, gave a bearish reversal, you get short in here somewhere, and then you'd play it back down here to the bottom end of the range and such. That would have been the idea. So we know that didn't happen. It shot up here. Now Kiwi, again, it's halts for trading here in this 15-minute window, but it's up here anyway. This chart has US dollar weakened. So this chart, when it reopens for trading here in 10 minutes, it'll be up here. A little too high and not the right setup. So good stuff. All right, we'll leave it there. Thanks everyone for joining us. Hope you enjoyed the FOMC meeting. We discussed some different thoughts, some different concepts. Be on guard, be ready certainly as the Fed press conference starts in about 25 minutes. That sets up a whole new trading opportunity as well. So if you're trading events on FOMC day, there's the statement event, which I don't really feel like I had anything to trade. And then there is the press conference, and that can have a whole nother reaction out of the market. So stay tuned for that. Thanks again, everyone. We'll see you next time. Goodbye.